Quite a massive project there. Let's bring in additional this morning now. Research analyst, financial derivatives company. Great to have you. It's been a while.
Hey, Ladi, good morning, and thank you for having me.
Good
Definitely
morning.
been a while.
Oh, yeah. So looking at the Dangote Refinery, scheduled to commence operations, the third quarter of this year, quite an incredible feat there. The capacity about 540,000 barrels per day. What are your thoughts on this development?
I think first of all, it's a brilliant development. It's been in the works for a while now. Started in 2013, cost around 16 to 18 billion US dollars. But it's positive in the sense that Nigeria, one of the biggest problems we have in Nigeria is, importing petroleum products, importing premium auto spirit, and which is costly in terms of the import bill, and also weighs heavily on the external weighs heavily on the exchange rate as well as the external reserve. So with this, I think I wouldn't say this is a silver bullet that solves all Nigeria's problems, but I think it will significantly reduce, pressures on the exchange rate by reducing Nigeria's import bill, particularly for petroleum products. It will also, because the plant also is going to export, some PMS and other, products to neighboring countries. So we're also going to enjoy some FX inflows. Also, I think it's positive for investors' sentiment, coupled with the petroleum industry bill. So overall, I think it's very good for Nigeria.
Yeah, but we still have the energy transition issue. Major companies are moving away from dirty alternatives. So what do you think about the timing, though?
Well, I think the movement towards, the greener energy is not going to happen overnight. It's going to be a gradual process. So in that sense, I would say that, it is still good. It's still a positive development. I mean, even in the UK here, the transition to net zero is around 2050. So it's still a very, very, very long time. And before then, I mean, we have to make some progress in the domestic market. So improving domestic refinery capacity in Nigeria, I think that's very, very positive, regardless of the transition towards, greener, cleaner energy sources.
Right. All right. Let's look at oil prices now. We see at $87 per barrel in the global commodities market. It's all talk about supply concerns and geopolitical tensions. What other factors are driving oil prices at this time?
Like you said, Vlad, the oil prices are topped, reached seven-year highs of around $88 per barrel, and they've increased around like 10-12% year to date, driven by many factors. One is demand supply gap. So demand exceeds supply by around like 1.5 million barrels per day, and it has increased from December up to January. We're also seeing some demand factors like expectations that oil demand is going to reach pre-pandemic levels this year. On the supply hand, we are seeing one spare capacity issues. I mean, OPEC Plus, plan to increase their output by around 400,000 barrels a day, 400,000 barrels a day monthly, but they've been struggling to do that. So that raises questions about spare capacity, that even if there's a need to increase supply, that OPEC Plus is struggling to meet such increases in supply. For example, look at Nigeria. Nigeria's oil production quota by OPEC is around 1.8 million barrels per day. But look at December, November, we were only able to produce around 1.3 million barrels per day. Same story with Angola. In addition to that, we have some geopolitical tensions. I mean, there's tensions between Russia and the West over Ukraine, and that has the potential to threaten oil output, particularly because of Russia is the largest non-OPEC producer. In the Middle East also, we have some geopolitical tensions with the United Arab Emirates. So all of these factors are what is driving oil prices forward. In terms of short-term factors, we're also seeing a stronger US dollar. Yesterday, the dollar strengthened against a basket of other currencies, against the backdrop of expectations of normalization in US interest rates.
Yeah, so we have so many factors pushing markets right now. But, still on domestic oil production, the federal government has postponed the removal of petrol subsidy, which was planned for July this year. Should we be cheering or crying here?
It's a mix. I think, okay, so let us argue, let us evaluate the arguments for and against subsidy removal. In terms of the arguments for subsidy removal, the proponents of that say that, there's a heavy fiscal burden. I mean, it's estimated around 1 trillion to 2 trillion naira that is spent on subsidy per annum. And the argument is that it is not sustainable. Nigeria is not a particularly rich country. So spending 1.1 or 2 trillion naira on 1.1 to 2 trillion, naira on subsidy per annum is huge and is not sustainable. They also argue that, the benefits don't really trickle down to the people that really, really need it. Looking at the arguments against subsidy removal, people talk about the timing, particularly now that Nigeria is still recovering from the adverse effects of the coronavirus pandemic. Removing the subsidy now could see, the price of PMS in the domestic market increase to as high as, 300, 350 naira per liter. But also that could, stoke inflationary pressures, and that could, further push people into poverty. Already last year, the World Bank estimated that, the pandemic pushed around 7 million Nigerians into poverty. So the timing, in addition to that, remember that 2022 is a pre-election year. So now there's always the suspicion that whatever, decision that is going to be made by the government has, political undertones. I think a better option or a more optimal way to remove, petroleum subsidy would be to improve, domestic refining capacity, like what we have with Dangote. If and when it comes on stream, I mean, it's scheduled to come on stream in the third quarter of this year. I mean, this is not the first time we have been hearing that it's going to come on stream today, tomorrow. So if it does come on stream, then that is a positive step towards easing subsidy, towards removing the petroleum subsidy, because now it will reduce, the dependence on importing PMS.
All right. Well,
okay, let me stop there.
Okay. All right, Desola. So, it's MPC decision day here, and, even we're waiting for the Feds later on. There's a general consensus among analysts that the MPC will hold all monetary policy parameters unchanged today at the meeting. What are the key considerations, and how will this affect the average Nigerian on the street?
Okay, thank you for that question, Ladi. So, the key considerations for the Monetary Policy Committee at this moment, one is, I think, the inflation rates. Inflation rates,
that's the big elephant in the room.
For the past 8 months, and just increased in December. I think that was, I mean, it's too early to say if that's an inflection point, if that's a change in the trajectory of inflation. I think it's too early to say. I think the increase in inflation was the marginal increase to 15.6%. was driven by seasonal factors, festivities, and so on. So one key factor is the inflation rate. Second one is the growth rate. In Nigeria's currently average growth rate for 2020 from Q1 to Q3 is around 3%, which is positive, it's modest, but it's still fragile. So I think the central bank is also going to focus on looking at economic growth, trying to consolidate the gains in economic growth. We're also going to look at factors like the exchange rates, higher oil prices in the global commodities market, looking at Nigeria's oil production, also the struggles with Nigeria's oil production, and other factors like that. I mean, but this is, again, against the backdrop of expectations of higher interest rates in the global economy. I mean, the United States is expected to signal to increase interest rates by around 4 times this year, starting in March. Also, they're expected to stop their quantitative easing program, I think, in March. Similarly, the Bank of England, started already, was the first to start increasing interest rates in their last meeting, I think in December, and their next meeting next month, they're also expected to increase it some more by, I think, 25 basis points. So even against this backdrop, I think that at this time, the optimal policy action would be to hold monetary policy
Okay.
parameters unchanged.
Looking at global hikes now, that would weigh on foreign taking foreign loans at this point.
Yes, it will. It will definitely increase the cost of servicing Nigeria's external debt. It could also trigger capital flights, pressure on the currencies, as well as dollar-denominated bonds. But however, we need to take our local context into consideration. The central bank has repeatedly emphasized that some of the key drivers of inflation in Nigeria are not monetary factors, and as a result, monetary policy is kind of handicapped against these drivers of inflation. Some of the key drivers of inflation are insecurity, banditry in farmlands, legacy factors such as the infrastructure deficits, logistic issues. And for these kind of issues, monetary policy is kind of limited or is constrained in targeting this issue. So if you can also evaluate all of the arguments. Even look at the argument for tightening. While it might help theoretically reining inflation, it could also help attract foreign portfolio investment, but it will raise the cost of funds, which will kind of reverse some of the benefits, some of the economic growth that Nigeria has been able to achieve last year.
Right, Desola, is like choosing between the devil and the deep blue sea here. All right, all right, Desola, all eyes on the MPC today. We'll be covering that live right here on Channels Television. Thank you so much, Desola, for coming on the program today. We'll take a moment now.